Hey everybody, Henry Becker here. This morning, being March 8th, 2011, I was going through my normal routine of news and blogs this morning and came across a video on MarketWatch.com, which was an interview with a gentleman, I think he's head of retirement planning services or something. His name is Andy Sieg. And it was about, this interview was about a study that Merrill Lynch had done on pre-retirement investors, meaning 20, 30, 40 something year olds, younger investors we'll call it, with portfolio sizes average of $250,000, saying that these folks were not taking enough risk with their portfolio. No kidding. In the video, they talk about, well, why, the interviewer asks this gentleman, well, why do you think that is? And they kind of threw around the hypotheticals or the guesses that, the dot-com blow up and the most recent blow up in the market has probably contributed to people, these younger investors being gun shy. Their experiences, they put money in, it gets cracked, they tiptoe back in, it gets cracked again. Now they're just sitting on the sidelines, which I wouldn't agree is the best thing to do. But at the same time, I don't blame them. The problem really isn't that. It's not that their experience in investing, sure, it is a problem. The real problem is they don't understand. Right? And they're getting misguidance and propaganda from these companies like Merrill Lynch, because the solution in this video is they need more equities. Really? Merrill Lynch, what do you guys sell? Equities, right? So a little self-serving, if I might add. So for me, the issue is these younger investors, not that they're not educated, a lot of them are highly intelligent. If they have a $250,000 portfolio, they did something right. They're saving money, right? The problem is they're not sure what to do with it. I work with, I'm an investment advisor. I work with people in all different age ranges. I have older clients. I work with some of their kids. I have younger clients. I have family. I have friends. I get a lot of questions. And the reality is, if you look at statistics, 7 out of the 50 United States require 7 out of 50 states require financial literacy of high school graduates, which means, I look at my education. I'm 41 years old. 20 years ago, when I was graduating from high school, or 20 plus years ago when I graduated from high school, the only thing I ever remember being taught how to do was write a check. Right? There was no how a mortgage works, how the investment world works, and even in college, there's no requirement to learn or at least most schools don't have a requirement in personal finance. So these people are coming out here. They're getting credit cards in college, solicited for credit cards all the time. Parents are giving it to them. They have cell phone bills. Their credit reports are being built early on without them really even probably understanding that and the impact of it. Every time they sign up for a credit card on a college campus, that's on their credit report as an inquiry. And too many inquiries, that's not good. So the bottom line here is, younger people, younger investors, not just college age, 20, 30, 40-somethings, a lot of them just don't have the financial acumen you need to navigate the markets today. And to have these guys on from Merrill Lynch and these big brokerage houses out there saying, well, you're not taking enough risk, invest in equities because over the long term, equities have done very well. Well, the long term is the chart that most people have seen. Over the last 80 years, the stock market's average annual return has been 10%. And for small company stocks, it's been 12%. And for bonds, it's only been 5%. So you want to have equities. Look at their return. Well, I don't know anybody that has an 80-year investment horizon except maybe the founder of IKEA, who started, the Swedish furniture company, who started his businesses at 6 years old selling matchsticks. So maybe he has an 80-year investment horizon because I think he's in his 90s now. But other than that, the vast majority of people's investment horizon is about a 25-year period. Look at the last 25 years in the stock market, right? Look at the last 10 years in the stock market. You have 2 catastrophic events. And if you look at what the Fed is doing, what our government, global governments are doing, blowing these bubbles by just printing and printing and printing money, investing in equities is getting to be treacherous territory, because every time we have significant problems, you see equity sell off, you see bonds sell off, you see commodities sell off. So just saying buy equities is a little short-sighted of advice. Obviously you can tell my ire has been gotten from this video. I just think it's very short-sighted, and I think people, younger investors, yes, they should hire advisors, as they say in the video. You know, if you're not sure what to do, it's beneficial to have an advisor. Yes, it is. But who's the advisor, and what advice are they giving? Are they telling you buy stocks here and now? You know, maybe there's some stocks worth putting money into now, but if you haven't been in it, you might want to wait a little bit at this point. You know, beginning of 2011, we're seeing significant runs in the market. You know, have these people at Merrill Lynch even look at balance sheets of the United States? They look at, you know, the debt level of the United States. We've created, you know, the U.S. has created $800 million, or sorry, take that back. $820 billion has been created of dollar paper currencies by the United States over the last 200 years leading up to the financial crisis. Since the fall of 2008, the federal government has printed 2 times that amount. 2 times that amount. Almost $2 trillion has been created in the last 18 months alone. That's more than the last 200 years combined. That's a problem. That's going to create a problem. Eventually, that's going to create a problem, probably sooner rather than later, for this economy and global economies. Look at, you know, and that's just one thing to look at in isolation. Look at the federal government's borrowing, right? The vast majority of borrowing is in the 2 to 10 year range, meaning they owe that money back within the next 2 to 10 years. And when they pay that debt off, they're using more debt to pay that debt off, you know, like recycling money. So when they pay that debt off, they have to borrow at a higher interest rate. That's bad. That's very bad, because what that does is increases the amount of interest our country is paying to service its debt. Just like you, if you have a credit card that's at 5% and they jack it up to 10, that's not good for your cash flow. And that's what's happening in the United States right now. So again, to come out and just say you younger investors aren't taking enough risk, buy equities, is very short-sighted. Gold, silver, commodities, farmland. There's many things you can look at besides equities, right? So, as I said, you know, the bottom line is I'm not opposed to equities. I mean, I have equities, my clients have equities, they've had equities. But at this point, to say you younger investors buy equities because over the long term they've done well, they don't have a long term. Nobody does. And the other thing too is, what is retirement? That's a whole nother video, and I think I'll do that later. What is retirement to these younger people? You know, I'm 40 years old. My retirement is going to look nothing like my father's, because Social Security more than likely is not going to be around, and if it is, it's not going to be what it is today. So don't bank on that. I don't have a pension. You know, the vast majority of Americans don't have pensions, and if they do, you'll be lucky to have them anyway because of underfunding. So retirement isn't, if it's even achievable at this point for most people, is going to be a very hard thing to pin down. So, as I said, you know, this video kind of got my ire up, and I just had to, you know, have something to say about it, and I thought, you know, somebody else might be interested in my thoughts. So, more to come. Thanks for your time. Look for some more videos from us in the very, very near future, if not tomorrow.